My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm trying to make some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. If we're really headed for a recession, like most money managers seem to believe, then as I have been explaining to Investing Club members, we have to change what we own, including on days like today, where the Dow slipped 100 points, S&P shed 0.67%, Nasdaq declined 0.85%. After 2 good days for the bulls, we're right back in the bear porridge. Yet something got me really steamed today. Really steamed. The street, meaning the collective people of research talent, is approaching this gut-wrenching moment with an incredibly two-faced attitude. What do I mean by that? On the one hand, the sell-side analysts who cover individual stocks keep pushing richly valued companies, including many unprofitable ones. On the other hand, the top-down research directors focus on the broader economy. They want you to know that a recession is coming, so you should avoid that exact type of stock like the plague.
The House of Pain.
Meanwhile, the stocks that historically hold up best in recessions have been lost in the shuffle, namely the high quality, well-capitalized companies with good balance sheets, big buybacks, meaningful dividends, like the ones I've been recommending here and buying for my travel trust, almost all of which are household names. That's why we need to explore this really bizarre dichotomy, where the giant brokerage apparatus keeps pushing the exact stocks that get crushed in the recession that they themselves are predicting. How do we explain that? Are these analysts just out of their minds? Are they being drugged? No, there's actually a straightforward explanation. First, even as the stock market peaked a little less than a year ago, the brokerage houses that pumped out expensive IPOs and sold them as great growth vehicles don't seem to understand that their era is over. At the same time, the doyens who make the top-down calls at the same firms do seem to get it, at least for the most part. They know the Fed will raise rates aggressively to stamp out inflation with dire consequences for the stock market. Now, see, the two views are very much at odds, and I'm afraid you're going to get hurt. What do the chief strategists see that the individual analysts don't? They know that every time the Fed raises rates, every time, earnings estimates for 2023 have to go down. See, they're in charge of trying to figure out the estimates and what they think big fund managers should pay for those earnings. They recognize that days like today, where interest rates go up, raise the odds for recession, and in recession, the earnings estimates are heading lower. They know this because every day rates go higher, like today, stocks give up their gains. Now, there is always hope. The top-down directors can't be sure that rates will keep marching higher. You never know when we'll get some data that's weak enough for the Federal Reserve officials to start talking about how the need to pause the relentless rate hikes is upon them. If that happens, the beaten-down growth stocks will indeed come roaring back, and you don't want to be caught with your pants down. And the brokerage firms don't want to give up the opportunity to capture those moves. And that I don't blame. But I am less sanguine. We know all sorts of commodity costs are coming down, but that's not enough. What's not coming down is the stuff the Fed really cares about now. WFH, meaning wages, food, and housing, not work from home. As long as there's no dent in those three, the Fed will hold the line on the need for aggressive rate hikes. We got a bunch of officials saying it just today. Every time they talk about how inflation keeps raging, rates go up almost in lockstep. Then when rates go up, earnings estimates for the S&P 500 have to go down. It is becoming a vicious cycle lower. Now let's switch back to the individual analysts. Until this year, we had a remarkable number of IPOs and SPACs that were created to take advantage of this booming market and low interest rates. We got a ridiculous number of electric vehicle plays, often because Tesla was such a big hit. What can you do with them now that even Tesla's feeling some pain, with the stock down meaningfully after hours because the company missed top-line estimates, even as it also beat earnings expectations for the 8th straight quarter? Not long ago, this was the type of quarter that would have sent Tesla stocks screaming higher. Now our instinct is to look for something that's wrong with the report. Like in this case, maybe the chance that Elon Musk might have to sell some shares to pay for his pricey Twitter acquisition. The brokers created large numbers of financial tech stocks because of the success of Square and a bunch of point-of-sale businesses. They raised money for a monster amount of enterprise software plays, an imitation of Salesforce.com, Workday, ServiceNow. Those are the faves of the big-paying client venture capital firms. They backed subscription retail outfits and niche internet businesses. They dreamed up biotech and drug companies that the market lapped up because Big Pharma kept acquiring them. And, of course, they created all sorts of mini FAANGs because the real FAANGs made so much money for shareholders. I'm talking Facebook, Amazon, Apple, Netflix, Google, and let's throw in Microsoft for the heck of it. But the one thing the brokers didn't do was care if these companies were money losers. They didn't care that they weren't profitable. They didn't need to worry because once they came public, their stocks would inevitably go higher. And they could just sell more shares to raise the money if they ever really needed it. They should have cared, though, because as they were doing this, the Fed decided enough was enough. They took away the punch bowl with an aggressive series of rate hikes in order to tame inflation, and the stocks went down, not up. Spoiled the whole story. Now, you have to understand the way Wall Street works. Research is a small part of the pie for the brokers. They make a lot more money by bringing new companies public. IPOs are a huge business for them. But that spigot closed, and the spigot for follow-on offerings is closed, too. Now these new companies are running out of money, and I believe that they will soon be in dire straits if inflation doesn't slow down because they can't do offerings. The analysts at the brokerage houses, though, the analysts, this is the problem. You see, they don't want to accept what I just told you. They just heedlessly keep promoting these kinds of stocks. I know they're not supposed to operate like this anymore. The analysts are independent, but I can't come up with a more reasonable explanation. Either they're trying to juice the investment banking side of the business, or they're just useful idiots, or maybe a combination of the two. Maybe they're just cockeyed optimists, though, who are costing everyone fortunes. What bothers me is that we know which stocks do best in an environment where we have a recession and raw costs come down. But prices hold up for many businesses. What am I talking about? I'm talking about Procter & Gamble. They reported today. They talked about how they have billions and billions of dollars of cost inflation. If the Fed wins its battle against inflation, those costs will go down. And if they can hold the line on pricing at the same time, their earnings will soar. By the way, we do own Procter for the Charitable Trust. Big position. Because this is what historically works going into a bad economy, and I have been through many periods of going into a bad economy. We heard the same thing yesterday with J&J, and then last week with PepsiCo. I bet we get the same thing from Bristol Myers, Coca-Cola, Eli Lilly. But those are state-owned companies that don't make the investment banking arms much money, don't have a lot of sponsorship anymore, unless those companies decide to make some acquisitions or break themselves up like J&J. So we have this terrible conundrum where the analysts keep promoting the money losers, even as the research directors warn and tell you to stay away, because these are going to be gutted as the economy slows down. Meanwhile, nobody's championing what actually works. These old-line consumer packaged goods names that we all know with high yields, big buybacks, real pricing power. When I went through Procter's quarter last night, this morning, they talked about $3.9 billion in after-tax headwinds. $3.9 billion. I bet those costs would be reduced significantly in a recession. At the same time, Procter's got brand power. They rarely lose business to trade down competitors, even in a recession. They also have an amazing research and development arm, along with some very sophisticated targeting advertising. But Procter & Gamble is not going to bring much business to an investment bank. I'm not surprised it gets overlooked. You know, for a full year, I have railed against the richly valued money-losing companies. I reiterate that stance today. I just wish the brokerage houses would get the memo. They really should know better. Bottom line, I want to chalk this up to hope, not selfishness. But when you get an amazing quarter from P&G and so many other old-line consumer packaged goods companies and drug stocks with terrific balance sheets and good yields, yet nobody cares, well, I'll tell you something. It tries my patience severely. Ian in Illinois. Ian.
Jimmy Chill, first time, long time. How you doing?
Ian, I'm a little unchill tonight, but I got to do my best. What's going on?
That's all right. Hey, I've got several friends using Dexcom, so that's what my question's about tonight. I know you said it's expensive, but diabetes is going nowhere, even in a recession. What do you think? Buy, hold, or sell?
Well, it is expensive, but I think the world of Dexcom, and they do have the best. They do have the best machine, and so therefore, if someone wants to buy it, I'm not going to be against it. But recognize that these very expensive stocks have had a very hard time in this market. All right, now listen to me. When you get an amazing quarter from Procter & Gamble like we had today and nobody cares, well, let's just say, I'm Steve. On Mad Money tonight, Netflix reported a quarter that was anything but chill, and I'm running through the numbers and sharing the details that you need to know. Then the airline stocks have bounced off their lows, so is this just the beginning of a move to the skies? Can you really own those stocks? Maybe go into recession? I don't know. We got to take a close look at the players. And BioMarin is on a mission to help millions with genetic diseases, and I'm learning more about the company's pipeline with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.